Most people think getting richer at work means earning more money, a better title, a higher salary, a promotion that finally makes the long hours feel justified. But there's a quieter question almost no one asks because it's uncomfortable and because the answer isn't flattering. If you've been working for 5 or 10 years, where did all that money actually go? Not in theory, not on paper, in real life. Because when you zoom out far enough, many middle-class professionals in the US and Europe aren't poor, underpaid, or financially irresponsible in the obvious sense. They show up, they studied, they followed the rules, and yet after years of work they still feel financially fragile. One job loss away from stress, one medical bill away from panic, one lifestyle downgrade away from embarrassment. The strange part is that nothing looks wrong on the surface. The salary is decent. The apartment is reasonable, the car isn't flashy, the spending feels justified, and that's exactly where the problem hides. Picture a fairly ordinary life. Maybe it's yours, or maybe it's close enough to feel familiar. You're in your late 20s or 30s. You live in a mid-sized US city or a European capital's outer ring. Your gross salary looks solid on LinkedIn. After taxes, social contributions, and healthcare, the number that actually hits your bank account each month is smaller but still respectable. Let's say €3,200 in Europe or $4,500 in the US. From there, the money starts flowing out in ways that feel inevitable. Rent or a mortgage comes first, not luxury, just market reality. Housing alone quietly absorbs 30 to 40% of what you earn. Then utilities, internet, phone, then transportation. Maybe a car payment that made sense when you signed it. Maybe public transport plus the occasional rideshare that adds up more than you expect. Then food, not extravagant, just modern. Groceries, lunches near work, the occasional delivery when you're too tired to cook. Somewhere in the middle are student loans, credit cards, or buy now pay later payments that don't feel like debt anymore, just background noise. None of this feels reckless. In fact, it feels responsible. You're not gambling, you're not shopping for yachts, you're participating in what modern middle-class life quietly expects, and that's why most people never question it. But when the month ends, what's left is often thin. Maybe a few hundred saved, maybe nothing. Maybe savings that exist mostly on good months and disappear on bad ones. Over time, a strange tension develops. You earn more than your parents did at your age, yet you feel less secure. You're technically doing well, yet you hesitate before taking time off, changing jobs, or saying no. And slowly, without any dramatic failure, work becomes the center of your financial survival rather than the engine of your financial growth. This is where the idea of the shadow portfolio begins, not an investment account, not stocks or crypto or side hustles. The shadow portfolio is the collection of financial commitments you build around your career without ever calling them investments. The apartment chosen because it matches your job status. The car that signals stability. The wardrobe that fits the office culture. The subscriptions that keep life convenient enough to sustain long hours. Each one feels small. Each one feels earned. But together, they form a parallel portfolio, one that compounds quietly, just not in your favor. Unlike a brokerage account, this portfolio doesn't show up on an app. It doesn't send statements. It doesn't feel like risk. It feels like life. And because it's invisible, it's rarely managed with the same care or skepticism. The uncomfortable observation is this: many professionals are fully invested already, just not in assets that build freedom. They've invested future income into fixed obligations. They've invested flexibility into comfort. They've invested optionality into predictability. And they've done it while believing they were being prudent. The danger isn't that these choices are foolish, it's that they are normalized. When everyone around you structures their life the same way, it stops feeling like a decision and starts feeling like gravity. And gravity doesn't feel dangerous until you try to move against it. This is why raises often don't change much, why promotions feel exciting and disappointing at the same time. The extra income rarely flows into ownership or independence, it flows into reinforcing the shadow portfolio. Slightly better apartment, slightly nicer car, slightly more convenience, slightly higher fixed costs. The job improves, but the financial position doesn't move as much as expected. Over years, this creates a subtle trap. You become very good at maintaining your life but not at changing it. And the longer this goes unnoticed, the more difficult it becomes to step outside it, not because you lack discipline, but because the system you've built around work quietly depends on you staying exactly where you are. The hidden mistake most people make isn't spending too much on any single thing. It's misunderstanding what their job is actually paying for and what it's quietly costing them. On paper, a salary looks like income. In reality, it's closer to a conversion mechanism. You trade time, energy, and attention for money, and then that money is immediately converted into fixed commitments that require you to keep trading time, energy, and attention at the same rate. The system works smoothly as long as nothing changes, but stability is doing more work here than intelligence. To see it clearly, you have to slow it down and do very boring math, the kind that doesn't excite anyone but explains almost everything. Let's take a simplified but realistic example. Say you earn $85,000 a year in the US or 70,000 euros in much of Western Europe. After taxes and deductions, you're left with roughly $4,500 or 3,200 euros per month. That feels like a solid income. Now watch what happens to it. Housing takes $1,600 or 1,200 euros, not luxury, just market rent or a modest mortgage. Transportation takes another $500 when you include payments, insurance, fuel, maintenance, or transit passes. Food averages $700 once you combine groceries, work lunches, and occasional convenience spending. Utilities, phone, internet subscriptions, and insurance quietly add $400. Student loans, credit cards, or installment plans take $300. Before you've done anything reckless or indulgent, you're already past $3,500. What's left looks like savings, but it's fragile. One repair, one trip, one slower month, and it's gone. This isn't bad budgeting, it's structural tightness. Here's the part most people miss. Those expenses aren't neutral. They are work-dependent. You don't just need income to pay them, you need continued income at the same level. Your apartment isn't just shelter. It's a contract that assumes your current job continues. Your car isn't just transportation. It's a fixed bet on your future earning stability. Even convenience spending is often a way to recover from work itself. You're not buying time-saving services because you're lazy. You're buying them because your energy is already spent. Over time, your lifestyle becomes optimized for sustaining your job, not for building financial resilience beyond it. This is where the shadow portfolio becomes expensive. Imagine two people earning the same salary for 10 years. One structures life so that fixed costs consume 70% of take-home pay. The other keeps it closer to 50% not through deprivation but through restraint and intentional mismatch between income and lifestyle. The difference might be $800 a month. That doesn't sound dramatic, but over 10 years that's $96,000 in cash flow difference. Invested conservatively, it compounds. Even uninvested, it creates breathing room. Meanwhile, the first person feels constantly almost there. Always one raise away from comfort, always one bonus away from catching up, but raises often arrive after expenses have already expanded to absorb them. The system flaw isn't personal failure, it's that modern middle-class life is sold as a bundle. Career success is expected to come with certain visible markers: location, space, convenience, reliability. None of these are inherently bad. The flaw is that they are financed with future labor, not excess capital. You're not spending past surplus, you're pre-spending tomorrow's effort. And because everyone around you does the same, it doesn't feel like leverage, it feels like adulthood. The math, however, is indifferent to feelings. When most of your income is already assigned before it arrives, your ability to redirect your life shrinks quietly. What makes this especially deceptive is that the shadow portfolio doesn't show losses. There's no red number, no dramatic crash. The cost shows up as absence, the absence of optionality, the absence of patience, the absence of time horizons longer than the next paycheck cycle. You don't feel poor, you feel busy, you don't feel reckless, you feel committed. And because your income supports your lifestyle just enough, you never hit a crisis big enough to force a rethink. The system works, just not for wealth creation. If this continues unchecked, the long-term impact is subtle but powerful. You age into your expenses. Your peak earning years are spent maintaining structures you can't easily unwind. Career risks feel irresponsible not because they are, but because your fixed costs make them feel existential. You become highly skilled at optimizing within a narrow band of choices, but deeply uncomfortable outside it. Financial intelligence in this context isn't about higher returns or smarter investments. It's about recognizing that the biggest financial decisions you make at work aren't in your investment account. They're embedded in the life you build around your income, a portfolio that never asks your permission but charges interest anyway. The reason this pattern persists isn't ignorance or lack of discipline. It's psychology, specifically the way humans adapt, compare, and rationalize within systems that reward conformity more than foresight. Most financial mistakes don't feel like mistakes when they're happening. They feel like alignment. You align your spending with your peers, your workplace, your age, your perceived trajectory. You don't wake up and decide to trap yourself financially. You slowly normalize a structure that depends on you continuing to perform at a certain level indefinitely. And because this structure grows gradually, your mind treats it as stability rather than exposure. One powerful force at work here is identity protection. Your job isn't just income, it's status, competence, and proof that your past decisions were correct. When your lifestyle reflects that identity, it reinforces a sense of coherence. The apartment fits the role, the car fits the narrative. Even financial stress gets reframed as temporary pressure rather than a structural issue. Admitting that the system itself might be flawed would mean questioning not just your money habits but your definition of success. That's emotionally expensive, so the mind avoids it. Instead, it focuses on optimization within the existing frame, budgeting apps, minor cutbacks, waiting for the next raise, anything that preserves the story. Comparison plays a quieter role, but it's just as influential. In most professional environments, spending isn't discussed directly, but it's constantly visible. Where people live, how they commute, where they travel, what they wear to work events. These signals establish an invisible baseline. Falling below it feels like falling behind, even if your finances are objectively healthier. So people aim for the middle of their reference group, not the maximum of their future options. This is why many financially stable choices feel socially risky. They don't signal failure, but they do signal difference. And difference is uncomfortable in systems built on predictability. Over time, this psychology produces a strange outcome. The more competent and reliable you become at work, the more financially constrained you often feel. You're trusted with responsibility, deadlines, and long-term projects, but not with uncertainty. Your financial life mirrors this. Everything is planned, allocated, scheduled. There's very little slack. Slack looks like inefficiency, yet slack is exactly what creates leverage over time. Without it, every unexpected event requires more effort rather than less. The absence of slack doesn't show up as pain, it shows up as fragility, and fragility only becomes visible under stress. If this continues for decades, the long-term impact isn't poverty. It's dependency. Dependency on steady income, dependency on good health, dependency on favorable job markets, dependency on systems continuing to function as expected. None of these are unreasonable assumptions until they're tested. The shadow portfolio grows larger with age, even as energy and tolerance for risk decline. Ironically, this often happens just as people reach their highest earning potential. They finally have money, but they have the least freedom to reconfigure their life. The job owns the calendar, the expenses own the income, and the future becomes something to manage rather than shape. What makes this particularly difficult to notice is that there is no single moment of failure. There's no dramatic collapse that forces reflection. Instead, there's a gradual narrowing of options. You stop considering certain moves not because they're impossible, but because they feel irresponsible given your current structure. That structure, however, was built incrementally, under assumptions that were never consciously examined. The psychological trap is thinking that because the system was built slowly, it must be safe. In reality, it's simply familiar. Financially intelligent people aren't immune to these pressures. They feel them too. The difference is that they recognize the shadow portfolio as something that must be actively constrained. They understand that every fixed cost isn't just a monthly number, it's a claim on future attention. They don't view stability as the absence of risk, but as the presence of margin. This isn't about asceticism or living below your means in a moral sense. It's about understanding that wealth, at its core, is the ability to absorb change without panic, and that ability is built long before you need it. When financially intelligent people look at work, they don't see a paycheck first. They see a system of constraints and possibilities. They ask a different question, not how much do I earn, but how much freedom does this income actually buy me? That shift sounds subtle, but it changes everything. Instead of treating lifestyle upgrades as natural rewards for career progress, they treat them as long-term commitments that must earn their place. The apartment isn't evaluated by how nice it feels today, but by how much future flexibility it quietly consumes. The car isn't judged by comfort alone, but by how many years of income it assumes will continue uninterrupted. This doesn't mean financially intelligent people live poorly or deny themselves enjoyment. It means they are selective about what becomes fixed. They understand that variable spending is manageable, fixed obligations are not. A dinner out can be skipped, a lease cannot, so they aim to keep their fixed costs intentionally lower than what their peers consider normal for their income, not because they lack confidence, but because they value optionality more than appearances. They recognize that the ability to say no to a job, a client, a location is itself a form of wealth, even if it doesn't show up on a balance sheet. At work, this mindset produces a different relationship with career progression. Raises aren't automatically absorbed into lifestyle. Promotions aren't immediately translated into higher monthly commitments. Instead, increased income is treated as surplus until proven otherwise. This creates a buffer between earning more and needing more. Over time, that buffer compounds into leverage. It allows people to take roles that may pay slightly less but offer learning, flexibility, or long-term upside. It allows them to weather industry shifts without panic. It allows them to negotiate from a position of calm rather than urgency. None of this requires extreme discipline. It requires restraint at moments when restraint feels unnecessary. Perhaps most importantly, financially intelligent people understand that the shadow portfolio is always competing with their real portfolio, even if they don't invest at all. Every dollar committed to sustaining a certain image or convenience is a dollar that can't compound elsewhere. They don't obsess over returns, but they are deeply aware of trade-offs. They know that wealth rarely comes from dramatic decisions. It comes from not letting small, socially approved commitments quietly solidify into lifelong obligations. They're willing to look slightly underleveraged in the short term to remain overprepared in the long term. This perspective also changes how work stress is experienced. When your lifestyle doesn't demand constant high performance, work becomes less existential. A bad quarter is an inconvenience, not a threat. A manager's opinion matters, but it doesn't define your survival. This psychological safety feeds back into better decision-making. You're more willing to speak honestly, to switch paths, to invest in skills that may not pay off immediately. Ironically, this often leads to better career outcomes, not because of hustle, but because clarity replaces fear. From the outside, this way of living can look conservative or even timid. There's no visible flex, no dramatic upgrades, but internally it creates a widening gap between income and dependency. Over years, that gap becomes the real engine of wealth, not flashy wealth but durable wealth, the kind that makes time feel less scarce, the kind that turns work into a choice rather than a requirement. And it all starts with recognizing that the most important financial decisions at work aren't about how much you earn, but about how much of your future you quietly pre-commit. The idea of the shadow portfolio isn't meant to make anyone feel trapped or regretful. It's meant to make the invisible visible. Most people don't struggle financially because they lack intelligence or effort. They struggle because they never realized they were building a second portfolio alongside their career, one made of obligations rather than assets. Once you see it, the story changes. Not dramatically, not overnight, but quietly in the way you evaluate choices that used to feel automatic. You stop asking whether something is affordable this month and start asking what it quietly assumes about your next 10 years. This awareness doesn't demand drastic action. It doesn't require selling everything or rejecting modern life. It simply restores agency. There's an uncomfortable question when you understand that every fixed cost is a claim on your future labor. You regain the ability to decide which claims are worth honoring. If I earn more than I did a few years ago, why does my financial life feel exactly the same, differently when chosen deliberately rather than absorbed by default? Just heavier, less financial intelligence. But there's always a low-grade pressure sitting in the background. Bills get paid. It's about alignment from the outside, how you earn, somehow how you live, and how much uncertainty you can tolerate without stress. And what's unsettling is that this isn't limited to people who struggle. It's common among people who are doing well. People with degrees, one pillar among stable jobs. That changes how success feels. People instead of measuring progress by visible upgrades, progress instead they feel permanently caught up, never falling behind, but never pulling away. Fewer career moves feel irreversible. Picture a fairly normal situation in the U.S. or Europe. Confidence that doesn't depend on constant someone in their late 20s or 30s. You don't need to prove you're doing well because your life structure already supports in the U.S. or maybe 50,000 euros in a major European city leads to better financial outcomes without aggressive strategies. After when you're not forced to maximize social at all costs, you can afford to think longer term. That income you can invest steadily, learn patiently, and take opportunities that don't pay land somewhere around $4,000. None of this feels exciting in Europe, depending on the country. Maybe the shadow portfolio thrives on excitement and €3,200. Already the number grows in different from the headline slightly salary. Boring decisions repeated consistently. Everyone knows taxes exist. If there's one thing to take away, it's not a rule or a tactic. The expenses begin to line up almost automatically. Look at your life as a system that either converts work into freedom or converts work into take-home pay. Not because someone is reckless, but because that's the market. Which one they're building until they feel stuck. Close enough to you don't have to wait for that moment. Just functional. Awareness alone shifts the trajectory. These aren't not because it forces action, but because it changes what feels reasonable going forward. Maybe it's a car payment in the U.S. If this way of thinking resonates, consider liking the video or public transit passes in Europe. Not for motivation, just for clearer conversations about money, expensive in isolation, but somehow always total more than expected by the end of the month. Student loan payments quietly draft themselves out. A credit card balance that